Welcome to the Talks Podcasts. Here are your hosts, Neil Seeger
and Marc Jovanovic.
Thank you for joining us.
No problem, it's good to be back.
Another month.
Another month
has flown by. They're flying by.
Yeah.
Honestly. How are we in the middle of the year?
I know. Well, tomorrow it's July when we're recording this. So.
Yeah, it is. Yeah, and midway through the World Cup.
Yeah.
Don't worry, it's not a football podcast.
No
We're not going through any of the football on this one at all. It's purely accountancy and tax on this one. So, Marc, we said we'd start it off with a myth.
Yeah.
Every time we'll start off with your myth of the month. So what have you seen on any socials which you think is a myth?
So something that came up in the last week really was about ISAs.
Yeah.
Now there are a few changes to ISAs announced last year, and one thing the HMRC announced last week was that they're going to start charging tax on interest earned in stocks and shares ISAs.
Okay.
Now that's been massively misinterpreted online on social media. I've seen loads of posts, people saying all ISAs now, what's the point in them? You're going to have to pay tax on your interest.
Okay.
It's only stocks and shares ISAs. So if you've got a cash ISA and you're earning interest in that, that's still in a tax-free wrapper.
Yeah.
It's if you've got cash reserves in your stocks and shares ISA that's earning interest, that is going to be potentially taxable. But you shouldn't actually have much cash reserves in those ISAs.
I was about to say that. Yeah.
It should be invested.
Yes, that's the whole idea of the stocks and shares. It's invested.
Yeah. And if it's not invested, you'd probably have it in a cash ISA.
And you won't be paying tax on the interest.
Exactly.
Ah.
So they brought this rule in because obviously they lowered the limits on the cash ISA.
Yeah.
But didn't lower it on the stocks and shares ISA.
Okay.
So, as a way of stopping people from moving their cash reserves into the stocks and shares ISA, and having the interest tax free, because you've got a larger allowance in there, they're going to charge tax on that interest if it's in a stocks and shares ISA.
So if I went to put all my money into a cash ISA,
at
the moment, from a tax-free threshold, I can put 10,000 in.
Yeah.
Okay, so I'll put that in. But if I put it into a stocks and shares ISA, I can put up to 20 in.
Exactly.
So this is to stop people putting in 20,000
into the stocks and shares.
Into the stock shares, but only investing 10,000 and having the rest 10 sat in cash to get around the rules.
Exactly.
You can't do that.
Yeah.
Right.
So a lot of people have been getting confused, thinking it's all ISAs and the ISAs are now completely pointless because you've got to pay tax on the interest in them, but that's not the case.
That is the myth. The myth is that it is on all, but it's not.
Yeah. It's only on any cash reserves that are earning interest in a stocks and shares ISA.
Wow. And I wonder you've been seeing that on your socials.
Yeah. And it's really annoyed me every time I've seen it. People not understanding the rules.
I can tell. I think it's good though to clear that up though, because that is something that is very confusing.
Yeah. And the thing that you get with social media is you get people making a big song and dance about that to get reactions off people.
Yeah.
Because it helps their traction. And all that does is put panic and worry into people that are relying on those people to give them advice.
And that's the whole idea of us having these conversations and actually talking about those things that come up and that annoy you.
Yeah, and put people's minds at rest as well.
Absolutely, yeah.
It's not quite as bad as what it sounds.
No, it's not all of them. It's just literally trying to... It's like anti-avoidance is reality what it really is.
Yeah, it's a very simple thing that people would have done otherwise. And if it's that simple, there's going to be something to stop you doing it.
Absolutely. Or there might not be to start with, but there will be eventually.
Doesn't take long.
It doesn't take long for them to see those things. So that's the myth done, and that was a really good myth. That was.
I'm glad you found it useful. Hopefully everyone does.
I find it extremely useful. So I'm glad that you've got it off your chest, and I'm glad that we've all found out a little bit about that one.
Yeah, and we've had some questions come in, haven't we, as well?
We have had some questions come in, and the one primarily has been around the income tax on rental income, which they changed in April.
It's changing from April 2027, so it's a change that's coming in.
Yeah.
Basically, if you have rental profits and you're as an individual, so not if it's in a company, you're going to have to pay an extra 2% on top of the standard rates.
Okay.
So basic rate payer, 22%.
So 50 grand and below, total income.
Yeah.
Including my rental. If it's 50 grand and below, it's taxed at
22%.
22%, but just on that rental amount.
On the rental, yeah. Higher rate taxpayer, so over 50k, 42%.
Okay. Wow.
And additional rate taxpayers, 47%.
47. So it is literally just 2% on top of the rate we paid before.
Yeah, on top of the normal rates. Yeah.
Which caused a bit of confusion because some people thought, I almost worded it a second ago, that if your income is less than 50,000, everything added together is then taxed at 22%.
No, yeah, it's just the property.
Just the property
profits, yeah. Now the interesting thing with this is, previously, your personal allowance, you used to be able to spread that however you wanted in the most tax efficient way.
Okay.
So generally, you'd put it against whatever your highest rate of tax is first.
Yeah.
So that then you only pay tax on the lower rate.
That makes perfect sense.
From April 27, you can't do that anymore. So what you'd have done previously is, say you had a salary of 12 grand and rental profits of 10 grand.
Yeah.
You'd have put your personal allowance against the salary, and then your property would have been taxed at 22%.
Yeah.
So you'd have wanted to switch that round, wouldn't you?
Yes.
So that you're only paying tax on your employment at 20%.
Yeah.
And not on the 22% property.
Absolutely, of course.
They've stopped you from doing that now. The personal allowance has to be used against employment, interest and pensions first before you can then set it against dividends or property.
So you really used it up generally by the time you'll have got to have the rental.
Yeah.
So your rental's tax last in effect then?
Yeah, out of those, because it's the highest rate, So
yes, out of those, yes.
Yeah,
other income sources, but yes.
So unfortunately, they've taken that away from us, that flexibility with your personal allowance.
So it's a lot more rigid than it used to be.
It is. And if you're a landlord and you've got rental profits, you're going to want to build these extra rates into your forecast that you're doing for the next 12 months.
That'll affect your return.
Your
return on investment will potentially drop by 2%, well, a percent, maybe 2%. Depends on how it all looks, but yeah.
Yeah. But interestingly, the mortgage relief that you get, that is also rising by the 2%. So currently you get the 20% tax credit, which we've spoken about on podcasts many times.
Yeah.
That's going up to 22% as well.
So it mirrors.
It mirrors, yeah.
Okay, so anything property-wise, it's in I've got to build in the fact that it's going to be 2% more.
Yeah, exactly.
Okay, that's really interesting. And I think if we're clearing that up, because I think that does provide an awful lot of confusion.
Yeah, definitely.
So Neil's knowledge. I know we've all been waiting for this moment. It's a point that comes up quite a lot actually, and quite a lot of people miss it. And it's P11Ds.
Yeah,
it's a real hot topic at the moment because we're in July. So any benefits which were given to, if anyone had any company cars, for example, or company healthcare, then anything that was given in last tax year, so up to the 5th of April 2026. Needs to be reported to HMRC by the
6th of July.
6th of July, and any Class 2 national insurance, Class 1A national insurance, needs to be paid by the
19th of July. Yeah.
That's all right. Then I was going to say 19th, but you have me covered there.
Yeah.
So it needs to be paid by them. But what do people miss? So people miss that you need to do a P11D, and some people will not have told HMRC they've had a healthcare or a company car, so they end up getting hit with a tax bill that they weren't expecting, because it's the employee's responsibility to tell HMRC they've got the company vehicle or company healthcare during the tax year, but the employer's responsibility to file the P11D at the end of the tax year. So by the 6th of July they have to get that filed. But it's important that what gets caught up in the P11D legislation. Now, company healthcare is very important. So other providers out there, but Bupa is quite a common one. And you've got your company cars. So a lot of people would like to so they want to have a pay rise, but they don't want to have all the tax that comes with that. They end up having a electric company vehicle, which is quite common, and then they should have a P11D on there, but it does get missed.
Yeah, you see gym memberships as well.
Gym memberships, yeah.
It's really anything that the company's providing the employees or the directors that isn't cash, but it's a benefit to them for their employment, basically.
So the one question I got asked the other day was, well, if I don't say it's my company and Mark's an employee of mine, if I don't have my company save tax on it, that means because I haven't saved tax, my company hasn't saved tax on it, Mark as my employee doesn't have to pay tax on it. Unfortunately, that rule doesn't work.
No.
It's different things. So if the company in reality should save tax on it, corporation tax, and Mark should pay tax on it as the employee, just because one isn't saving it doesn't mean the other doesn't have to pay it.
Yeah.
Okay. And it also doesn't get me out the national insurance. Me as the company doesn't save me the national insurance because it's still effectively money that I'm giving to Mark instead of salary.
Yeah,
effectively.
That's it, yeah. And the company, you get the corporation tax relief on the cost of whatever benefit is you're providing to the employees.
Yeah.
But also when you pay that Class 1A national insurance, that's also tax deductible for you in your corporation tax.
So corporation tax on both.
Yeah. So it's not all doom and gloom.
It's not. It's just really important to report it, because if a P11D is due and isn't reported, then it does come with penalties.
Yeah, HMRC could open an inquiry into it, and you don't want them poking around into everything, really.
Absolutely not, no, because it generally starts with a P11D inquiry and then builds up into other aspects of the business. So just file a P11D, makes life a damn sight easier.
Yeah, and it's worth noting as well, P11Ds, the way you're reporting your benefits, currently done on the end of year P11Ds that we've spoken about, from April 2027, if you've got a company car or private medical, that has to be then reported via your payroll, just the same way as what your salary is. So at the same time as reporting your salary each month, you've got to do the benefits if it's a car or private medical.
So if it's a car and private medical, I'd put it through the payroll, and I don't need to do a P11D.
No, so that's the phasing out of P11Ds basically. Okay. They're moving it all to payroll, starting with cars and private medical, and then other benefits will be brought in as well. You can bring other ones in sooner if you want, but it's cars and private medical have to be done.
So I could blanket anything. So it could be a gym membership, it could be a car, it could be healthcare.
Yeah.
I could put all them on the payroll from April 2027 to keep it nice and simple.
Yeah.
But I don't have to.
No.
But I have to do the two, which is the car and the healthcare.
Yeah, which could mean you end up doing cars and healthcare for your payroll, but then having to do a P11D for your gym membership.
Okay, yeah, might just be easier, just put it all through the payroll, but that's case by case, that's personal preference, that is, but
Yeah, there are two that you can't put through the payroll, and that's accommodation and beneficial loans. That's purely just to how they're calculated, but the plan is at some point in the future for them to be brought in.
Or go through the payroll.
Yeah.
But we're not there yet.
No.
We're not there yet. That was a good addition to Neil's knowledge, that was. I don't know, how can we word it next time? I have to think of a new word. It's a Neil's knowledge. If we're going to have a hybrid one, we'll have to think of a new word. But yeah, I think that's covered all the points for this month.
Yeah.
But if we have missed anything, or there's anything you'd like to go through,
please get in touch. Drop us a WhatsApp on 01905 777 600.
I was waiting for you to look at me then for the number. I almost joined in then.
I like to keep you on your toes, so I don't really throw at you or not.
You do. But thank you for joining us. I look forward to joining you next time.
Brilliant. Until next time. Cheers,
everyone. Thank you.